to the time limits of our class, there were certain workbook material we were not able to cover, and this very short video is a part of that coverage. This video is accompanied by a little bit more lengthy video that completes the presentation of the workbook. But let's start with this short video first. This involves one slide, and this would have been the slide one page, one workbook page, and this would have this represents the next page we were about to cover when class time ran out. So after we've recorded all our inventory movement and variances, we have to close our variances out to cost of goods sold. So at the end of the accounting period, all net standard cost variances, so the standard cost variances, all of them are closed out to the cost of goods sold account. Now here's the example. The items you see in these T accounts are the debits and credits we had made from our previous examples in terms of the different various entries. And we see raw materials with a debit balance, $8. That means there was $8 worth of unfavorable variance. Remember, debits are unfavorable. So there's $8 of unfavorable variance in materials purchase price variance. In materials usage variance, there was a $4 credit, meaning that it was a favorable variance. Labor rate variance was $2.50, indicating it's unfavorable. Labor efficiency variance has a credit balance indicating it is favorable, and factory overhead has a variance of $12 indicating that it is also favorable. So let's go ahead and close these accounts out to cost of goods sold. So the first thing we look at is the raw material purchase price variance account. It has a $8 debit balance. In order to zero that account out, I've got to make a credit to that particular purchase price variance. And there it is, my $8 credit to my raw material purchase price variance. That then results in debits, total debits equal total credits. So the account now has a zero balance. And you can see the $8 credit I made to the key account. You can see the journal entry there for the $8 credit. Let's do material usage variance. Material usage variance has a credit balance. Therefore, I'm going to make a debit to zero out the account, and I enter my $4 material usage variance as a debit in my journal entry. Labor rate variance, again, I'm going to have to zero it out, and the way I'm going to do that is, since I have a $2.50 debit balance, I'm going to insert a credit balance of $2.50. The debits offset the credits, so I have a zero balance. And you can see the representation of that journal entry would be credit to labor rate variance, $2.50. Now we're going to do this same thing to the labor efficiency variance, where I have a credit balance, so I need to offset it with a $5 debit balance. When I do that, my total debits equal my total credits, which would be then zero, the zero balance. So my labor efficiency variance comes out to $5 as part of the journal entry. The last area we use factory overhead with the credit balance of $12. In order to offset that amount and zero out the account, I have to debit the account for $12, which will zero out the account, and that debit then will be put into the journal entry at $12 for factory overhead. Now I have a journal entry that basically is out of balance. Our debits don't equal my credits. You can see my total debits are equal to 12 plus 5 plus 4. That's $21, and my credits are equal to $10.50. So what I need to do is to make the journal entry balance. In order to make the journal entry balance, I take a look at the total debits, which are $21, and total credits, which are $10.50. So again, to make that balance, I'm going to have to insert a credit, and that credit is going to go to cost of goods sold for the difference, which happens to be, in this case, $10.50. So I'm going to credit cost of goods sold for $10.50, and you can see that reflected up here in the cost of goods sold account. So in effect, all my balances in the variance accounts are now zero, and all those balances have been flushed in to the cost of goods sold account. And that's the end of this video. Okay, you will have another video that gives you an example of how we would do an entire inventory cycle for a company called Tyrek using standard costing. So when you have a chance, go on to that video.